Y'all keeping warm? It's cold. Listen, it is cold. Good Lord. So we'll go ahead and get started. Sorry we're running a little behind tonight, but we'll get in and get out. Nobody get hurt. Okay. All right. Let's go. Let us open with the word of prayer. Our Father, we thank you for blessing all of us to see another day. Lord, we thank you for meeting us when we woke up this morning and deciding that it was our time to get up and to go out into the world and to live the life that you have given us. And we thank you, God, for every moment, every minute, every hour. We thank you for all the time that you give us. And Father, we thank you for blessing us to be able to make it through the day, to make our way even down to the house of prayer one more time. We fought through the cold and the traffic and everything that told us not to come and not to go. And here we are, God. We just give you thanks and glory for who you are and what you do. Father, we ask that you would bless us tonight with your spirit, bless us with your presence, give us your wisdom, give us your guidance and understanding. Help us to hear what you desire to say to us. Increase our learning so that we may grow and understand better how to be better stewards of what you've put in our hands. Father, we thank you, we love you, we honor you. In Jesus' mighty name we ask it and we pray. And everyone say it together. Amen. All right. So, so last week we were streaming. We streamed this, and tonight we're going to stream it. But we may not continue to stream, and the main reason is because people need to be here. This is bottom line. And there's some things that we're going to do that you're not going to be able to do at home, or it's not going to work the same. And so once we get people into groups and you guys start looking at things and doing stuff, like, you're going to need to be here in order to get that interaction. So, but there are some people who they listen online, they watch online because they can't come. They're not able to. Either they're working or we have quite a few people that listen and watch from out of state. And so for those of you who listen and watch out of state, what I want you to do, and I'm talking to people online now, what I need for you to do, if going through these lessons on investing, particularly in the stock market, if these lessons have been a blessing and helpful for you and you want to continue, what I need for you to do is to put your name and email address in the chat, okay? Put your name and email address in the chat, and we're going to hook up something special just for you, all right? And so when we no longer stream, you still will have access because we're going to do something special just for you, okay? So if you can do that, that would be helpful. All right, so here we go. I want to start off talking about, matter of fact, let me just ask this question. How many of you guys are brand new to investing or stock market, anything like that? Okay, gotcha. Okay. All right, so I'm going to do kind of what I did last week is I'm going to start off like at the base level. And then because there's a level of learning that I want to make sure that all of us have. There's a level of information we all need to have. And then for those of you who are here and you're veterans, you longtime pros, you're already multimillionaires, just kind of hang in there with me. And then chime in when we come down your street, okay? All right, so here we go. So I want to talk about, and I'll talk about this at different times, but I want to start off talking about market attitude, okay? there's a particular attitude that that is in the stock market. The stock market has a tude. It has a whole attitude. And I talked about this last week, and the attitude of the market is simply this. The market rewards tomorrow, today. You got that? Missed it? Give it to you again. The market rewards tomorrow, today. You got it? The market rewards tomorrow, today. What do you think that means? What do you think that means? The market rewards tomorrow, today. What do you think that means? There you go. Forecasting. So the stock market, and I told you this last week, the stock market is always looking it's always looking forward. It's always looking into tomorrow. Right? It doesn't care anything about today, and it doesn't care a whole lot about last week. It's looking for tomorrow. Okay? And so let me give an example of what I mean, right? This is hopefully you understand what I mean when I show you this. So, you see this? Can you see that? All right. Now, this is one of the stocks in my account. Okay? So I had a particular stock called GEV. We talked about GEV last week. We'll talk a little bit more about it tonight. So I had an option call on GEV, okay? And my option doesn't expire until January 16th, 2026. However, whenever you have an option play, you always want to get out of it about 30 to 45 days before the expiration date if you're going to sell it. Okay, more about options later. But this was my option call, right? So I was banking that it would get to $650. That's what you call a strike price. Again, we'll get into that later. But as you can see, it was up yesterday. So they paid me $215 yesterday. But I was down overall $1,900. Right? Yesterday, it gave me a 7.78% return, which represented about a 215, but I was down overall 39.19% on the entire call. Right? So, I went to sleep last night, woke up this morning with my mind stayed on Jesus. And that's what my account looked like this morning at 7 o'clock. Right? Right? Went to yesterday, today. Yesterday, today.
What's that number that you're pointing at right now?
Which one?
The 30, 60, and the 80, 60.
The 3060 is so when I start explaining when we get into options, I'll explain to you what we call contract costs. Okay? So the contract cost for this option yesterday was $30.60. When I went to sleep and woke up this morning, the contract cost was $86. Right? Which meant I went from negative 1,900 to positive 38, almost $4,000. All right? And so I sold it. Right? Right? Absolutely. I took the money and ran, right? And so in one night, in a few hours, it gave me 193.12% return, right? Which took me up from negative 19 to positive 38. Overall, I was up 78%, so I sold it. Right? I'm too close to the expiration date to let it ride and to see what else it's going to do. I'm out. Right? And so yesterday, today. Now, the question is, why did it go from this to this overnight? Why was this like this yesterday, and why was this like this morning?
Especially when the market
You're exactly, especially when the market closes. But they're in a different market too. Yeah, because you have.
I always hear this. I used to listen to one guy who would always talk about, well, this is what it is up until close, but then there's always the stuff that happens after close.
Aftermarket trading. Yeah, yeah, yeah. You have pre-market trading, which happens right before the market opens. Like, how long is that? It's like, what was it, like an hour, hour and a half, something like that? About 2 hours maybe. So that's called pre-market trading. And then there's post-market or aftermarket trading, and it's normally like a few hours after the market closes. And so, but this is what happened. This is what happened. So the market closed yesterday, right? Our time, 1 o'clock, boom, market closed. Round 3:30, this came up. Right? This came up. Right? So GE Vernova, that's what I had. GEV. A strong financial trajectory with substantially higher returns expected beyond. When is 2028? That's tomorrow, right? It's tomorrow. And so now anticipates 52 billion of revenue and 20% adjusted EBITDA margin by 2028, up from 45 billion of revenue and 14% adjusted EBITDA margin. 18 gigawatts of gas turbine contracts signed quarter to date. Expects to reach 80 gigawatts of combined slot reservation agreements and backlog. Backlog means people are standing in line waiting to do business with them. That's backlog. So they have agreements and backlog by year end. Expects to grow total backlog from 135 billion to approximately 200 billion by year end 2028, inclusive of doubling the size of electrification backlog. Here's what they're saying. People are lining up to do business with us, and more people are coming. Right? What they're saying is we are becoming the in and out of energy. You know, wherever you go to in and out, it's always a line. I don't know, it's always a line, right? And so this came out yesterday afternoon. And then again, here's another headline. And so and you got to be careful with these headlines. Right? And now I'm probably the least most conspiratorial guy that you'll ever meet, but I've been in the market long enough to pay attention and know that they put these headlines out at some interesting times. Right? It's like some interesting times. And so this came out after the market closed, when nobody really could do anything, and the only people who could actually get in the big money are the big guys, right? Who have access to aftermarket trading. And so us little guys are sitting over here like, man, I hope that lasts until the morning, right? And so, because I was at home looking at my negative, I'm like, and I'm watching it run up aftermarket. I'm like, ooh, and I'm like, man, I hope they don't pump and dump this thing by the morning and the market opening, the thing start going down. I want to get out of my trade too. So when I got up, it was still running. That thing was moving, right? And so I got out, sold, I'm in the money, all right? But this makes my point. What is the difference between one and the other? It's how the market sees tomorrow. Right? It's how the market sees tomorrow. So watch this. Do you know this guy? You know him? Never heard of him? Say what? Not that Larry? Okay. All right. So who is this guy? Right? This guy is the CEO of GE, right? He's the CEO of GE. And I've learned that the right CEO can make a huge difference in a company, right? So watch this. He's eliminated substantial debt. He has raised revenue. And he has increased profits. What else do you want a CEO to do? Right? He's done all the right things, right? He's lowered the debt, he's raised revenue, and he's increased profits, right? And as a result, GE has gone berserk. I think I told you last week, GE, for those of you taking notes, you might want to write this down. GE has subdivided themselves into 3 different companies. There's what's called GE Aerospace, right? And this is the company that where they focus in on airline, the engines, the jet engines that fuel that they strap on airplanes, all that kind of stuff, right? So they're into that, and then there's some other stuff behind that too, because you have like these huge turbines they have, and it's a bunch of business that they do. With GE Aerospace. And then you have GE Vernova, which is more like your typical, the GE company that everybody knew, but there's also some expanded stuff with that has to do with energy and energy production and all of those things. So that's GE Vernova, okay? Then the last one is GE Healthcare, okay? Now, watch this. Let me show you something. This is GE Aerospace. Take a look. Can you guys see this, or is it too small? Okay, scoot up. Because I can't make it bigger. Okay. So this is GE Aerospace. So GE Aerospace is how much a share right now? $283. Now, here's what I need for you to see, right? So on the one day, it's down 0.68%. In 5 days, it's down 2.77%. In 1 month, it's down 8.50%. However, in 6 months, it's up 20.68%. Year to date, meaning from January 2025 to right now, it's up 68.89%. I don't know if y'all understand what the numbers are. That is huge. That is the entire stock market doesn't go up 68% in a year. And this one company, 68% for year to date. In 1 year, so if you go back to last year this time and then you bring it forward to this year this time, they're up slightly lower, 65.84%. In 5 years, guess how much they're up? $404. That's quadrupling your money in 5 years. And all time, since they did the break and then they started officially again, 5.85 thousand %.
When you say the break, you mean when they made 3 different companies?
Are y'all seeing what I'm putting down? Look, so, right? Here we go. Okay? CEOs have great impacts. They do. All right? Here we go. GE Vernova. That's the one I just did the options play on, right? GE Vernova. So watch this. One day, which was today, they're up 15.62%. This is how much they added to their stock today. $97 added today. That's big. That's big. And so they're up 15.62%. In 5 days, they're up 14.61%. In 1 month, they're up 23.47%. 8.3%. In 6 months, they're up 51.36%. Year to date, from January 1st to today, they're up 117.25%. Right? In 1 year, they're up 116%. All time, they're up 528.70%. Right? This is GE Healthcare, right? Much smaller numbers, they're not rocket science numbers, but they're positive, right? And so 1 day, they're up 1.73, 5 days, 1.88, 1 month, 14.97, 6 months, 17. Year to date, they're up 7%. 1 year, they're up 2.5%, and all time, they're up 34%, right? So it's a much smaller growth pattern, but they're still positive. Why is that important? Because what I'm trying to tell you is that if you're looking for something that you might want to take a look at and put on your watch list, you might want to take a look at GE, because their CEO is a top-notch CEO. And a top-notch CEO tends to bring great performance to great companies. In fact, they make great companies, and then the performance follows the greatness. Okay? And so GE is right now, before, I wouldn't have told you to look at GE for anything. But right now, they're doing really, really well. The CEO is top-notch. The returns are there, as you can see. And all of their forward-looking projections and like everything that they're looking at is, right? So, GE. Any questions about that? Does that make sense as I'm describing it to you, as I'm explaining it?
Your aforementioned was about conspiracy
Mm-hmm.
before you came here.
Mm-hmm.
Any correlation, or you want to expound more? Or you break it down later?
Yeah, let me hold off a second. Yeah. Okay, all right, here we go. So the question becomes, what makes stock prices go up and what makes stock prices go down? Okay? That's the fundamental question people want to know. What makes stock prices go up and what makes them go down? So here's what you have to understand. There are two different types of investors in the market. There's what you call retail investors, and then there are what are known as institutional investors. Is everybody with me? There are what? And? Now, who are the retail investors? This is us. Okay? Not the show, but in reality, this is us, right? We are retail investors. That's what we are. That's who we are. We are retail investors, okay? And one of the key things about a retail investor is this. Retail investors, let me explain a couple things. Retail investors have more freedom than institutional investors. However, retail investors don't have enough money to move the market. Okay? Like all of us in here combined, if we sold everything we had and went liquid with everything, cashed out all policies, all our earthly goods, sold all the properties, and put everything on a stock, the market would be like, thanks. right? Appreciate it. Right? But we don't have enough money to move the market, right? And so as a result, as a retail investor, here's what we do. We follow behind the institutional investors, and we pick up the crumbs that they drop. We ride the waves they create, right? That's literally how this works. And so Institutional investors would be these guys, right? They're the venture capitalists. They're the hedge funds, the mutual funds, private equity funds, endowment funds, insurance companies, pension funds, right? So these guys come into the market and they move the market because when they come in and buy stocks, these guys are buying, these not like we'll go in and we'll be like, man, let me, like, GE, hold on. Yeah, so GE Vernova is $732 a share. So we'll be like, man, I got two of them. Right? You know what I mean? I got two of them. You know what I mean? So, next month when I get paid, I'm going to get a third one. That's how we do. When these guys show up, they like, yeah, give me 1.5 million of those. Just like that. Yeah, give me 10 million of those. Right? And so they come in and when I say move the market, they move the market. Right? And so yeah, we don't have money like that. But these guys, we call these the whales. These guys come in and they absolutely move the stock market. So when you see the market going up, it's because these guys are buying. And when you see the market going down, it's because these guys are selling. Does that make sense? Huh? Yeah, a lot of times they're the richest people on the planet, but even bigger than that, they represent corporations. They represent institutions that have all this money that they're introducing into the market, right? Now, again, for us, we have a little bit more freedom than these guys. And the freedom and the reason why I say that is because these guys have to move in and out of stocks on a regular basis, right? They have to create waves. And why? Because they have people to be accountable to. They have stockholders. They have, there's a lot of people that they are accountable to make money. So they have to consistently move. But that's good for us because when they consistently move, it consistently makes the market go up and down. And if we can learn the pattern of how they move and when they move, like I told you last week, right? It's like double dutch. You know what I mean? And so, stop calling me. So when you kind of get in rhythm and you find out, oh, that thing is dipping, oh, but it's going to come right back. You just wait and you buy the dip and then you ride it back up. That's the idea. Is everybody with me? Okay, so here we go. So now there's two things though. And I told you guys this over the last couple of weeks or so, is that what you want to do is you want to learn how to buy in the dip. Remember I said that? You want to learn how to buy in the dip, which means this, that when the stocks go down, on your screen it's going to look red. In your head, it has to look green. All right? When the stocks are running up, on your screen it's going to look green. In your account, it's going to look green. But in your head, you have to see red. When the stocks are going up, when they're running up, it's going to look green. And everybody likes that. But you have to be careful. You got to be disciplined as an investor. And when you see the stocks running up, you got to be willing to sit on the side and miss out on that money because for you, it's red. Okay? And when the stocks are going down and everybody's talking about, this is Armageddon and Jesus is coming back tomorrow and, you know what I mean, all of that stuff and everything is woe is me, that's when it's green. Right? And you got to catch the rhythm of it, right? There's a rhythm to it. You got to learn how to catch the rhythm of it. Now, let me kind of help you a little bit. Um, just because stocks go down doesn't necessarily mean that's the time to buy. You got to know which time you're in. Okay? So, let me give an example. Here we go. The question becomes, why do stock prices go up and why do stock prices go down? The base answer is, when the big boys are buying, stocks are going up. When the big boys are selling, the stocks are going down. That's the base answer. But you have to learn the difference between what's called a sell-off and a pullback. You got to learn the difference, okay? Now, the question becomes, what is a sell-off, right? A sell-off, listen carefully, is not the time to buy. Don't buy. Say, don't buy. In the sell-off, don't buy, okay? Don't buy in the sell-off. Now, the reason why you don't buy in the sell-off is because something is wrong. Okay? Something is wrong. And what's happening is the big boys are selling because they're trying to get out of a play because they're trying to preserve capital. Right? They're not trying to go down with the ship. So they're abandoning this stock or company or whatever it is because something is wrong. And something is either wrong with the company, right? Something changed with the company. Like, I'll give an example. So, like, I forget the guy's name. I forget his name. No, not Campbell's, from Chipotle. Yeah. It's something. I forget his name. Yeah, he went to Star. So about a year ago? Yeah, so about a year ago, Chipotle lost their CEO, and Starbucks wooed him away, right? And so as soon as he went to Starbucks, Starbucks stock took a pop up. Why? Because, How? That's his name? They did. Yeah. Yeah. I, no, the Chipotle person went to Starbucks. I don't know where the Starbucks guy went. Brian Nichols, that's the guy's name. That's his name. That's the guy that left Chipotle and went to Starbucks. Yeah. And yeah. And so what's interesting is this. If you watch Chipotle stock has been ever since he left. Right? Starbucks stock popped, came back, and now it's kind of stable because he's working, but he hasn't been able to do for Starbucks exactly what they've been looking for him to do. But it's going to probably take a couple of years for him to actually make the changes he wants to make. But this guy is a proven CEO. He did the same thing for Taco Bell. What he did for Taco Bell, he did for Chipotle. I don't know if you guys remember. Remember Chipotle had that E. coli situation, and they stock. And then they brought this dude in, and he was like, nah, come on. And then Chipotle stock, Chipotle stock got up to like $3,400 a share. And then it split 50-1. We'll talk about splits later. But
And you know what? Starbucks, for maybe the last couple of years, it feels like it's been on restriction.
yeah.
Well, they got in trouble with they had those two black guys sitting in there and called the police on them. And then they all closed down for some equity training or whatever, and that hit them really hard.
Yeah.
Start taking like the electronics out the buildings and then kids like the stuff and you can't sit there anymore.
Mm-hmm.
And then just the narrative of like, save your money.
Now they got
Starbucks.
Starbucks.
Yeah.
That's like,
Right. Yeah, that's been their Achilles heel. That racial stuff. Yeah, that racial stuff has hurt them bad. And so, but yeah, so if, and again, all of those things, right? If there's a change in CEO and the CEO is not as good, that's a change in the company, right? If you got an E. coli scare, right, that's a change in the company. That's your product is not trusted anymore, right? If you're investing in JetBlue and 5 JetBlue planes go down, listen, right? The stock is going down with the planes. I'm telling you, because it's a just like who was that got Boeing? Is it Boeing? Boeing. Oh man, right? And so that's a tough situation, right? So when big boys start dumping, it's because something is wrong, and it's either wrong with the company, or there's something wrong in the market, right? And so maybe we're going into a down market, what we call a bear market, where everything is going down, right? And so it could be a company event, it could be a market event, or it could be a culture event like COVID, right? So COVID hit, boom, that affected everything. And so you had stocks like plummeting and companies even going out of business, right? Because of COVID, because people could no longer utilize certain services, right? I don't know if you remember during COVID, one of the biggest industries that took the biggest hit was the travel industry, right? So whether it was airplanes, cruise lines, I think like you could buy Carnival for like 50 cents or something like that. Like it was super cheap. And so especially after they showed, remember the people got stuck on the, listen, people were like, mm-mm. Mm-mm. And so they dumped all that stock, right? And so, but this is what you call a sell-off. A sell-off happens whenever something is wrong. And when something is wrong, don't go charging in, right? Save your money. Yes, ma'am.
But even if it's a proven company, because I want to ask you about Campbell's in this, they just fired homeboy, and I'm thinking this is the best time because Campbell's been in business forever, and this is just something where it's gonna dip, and then soon it's gonna
Maybe.
maybe.
Maybe. Yeah, maybe. Yeah. Yep. Right. Right. Yeah. Yeah. How it's going to shake out. And there's some other factors. One, Netflix is one of the only technology companies that hasn't bowed the knee to Sir Trump. And Trump has friends. So so you talking about a war kind of situation. And when the big boys see that, because they all know each other, they like, hey, right?
Trump said he's gonna be in on the decision making.
Yes. Yes.
He always say that.
Yeah. So so it could be a good deal, but here's the thing. From a retail investor standpoint, we don't know enough as to whether or not it's a good deal or not. So yeah. Yeah. So yep.
So would you call something like, okay, I heard that the Georgia film studios is leaving and they going overseas and stuff.
Hmm.
Would that like affect the tech sector? Would you say like mildly or?
I wouldn't think so. I don't think that because they're not a major player over there. Yeah, and so now if NVIDIA, yeah, that would be a world event. Yeah. So yeah, if NVIDIA did it, yeah, if NVIDIA because NVIDIA is it's the number one company in that sector. There's nobody. Matter of fact, in the stock market, I don't think there's anybody bigger than NVIDIA right now. Yeah, so that would be a major situation. Okay, so here we go. So that's sell-off. Everybody got sell-off? Then there is what we call pullback. Okay, pullbacks are different. All right, so pullbacks is typically what happens in a pullback is the stock runs up like this. Right? It'll run, boom, 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 and it'll get so high, and then the guys will be like, man, we're at all-time highs, right? The big guys, we're at all-time highs. And so then let's take profit. So then they start selling because that's the only way you get your profit is that you have to sell. And so they're taking profit. Why are they taking profit? Because they need to report they need to report profits to their shareholders. They need to report profits to the stakeholders that give them the money to actually invest. So these guys, they'll run it up, boom. Then they'll take profit. When they start taking profit, they're selling, it's coming down. But if there's no problem, it's just a pullback. Right? It's not, there's nothing wrong. So then what do? Get ready to buy. Right? This is this. Right? You're looking for your entry, right? At that point, okay? And so get ready to buy and relax. Everything's okay. It's just a normal, natural pullback.
So when the other class, you talked about patterns.
Mm-hmm.
So we would have to, in order to really recognize this, wouldn't we have to start really getting into watching the patterns?
Oh, yes. Oh, yes. Yes. Yeah.
Because the only way I would know to do that is you find a pullback.
Right. For sure. Yeah, for sure. Yeah. Yep. You gotta, and remember I was telling you guys before, like, you gotta read. This is why I'm saying you have to read. When you really kind of get in here, if you want to make some solid inroads, you have to read and you have to become a student of it where you get familiar with the patterns, right? And then there's two ways, and then once you start to get familiar with the patterns and you start seeing it, how it works, you'll learn. There's been stocks that I haven't purchased, but I followed it for like a year, just following it. And I'm like, man, they got a pattern, right? And I just pick up on the pattern. They got a pattern. And I've done this a few times where I'll catch a stock and I'll be like, man, this thing trades in between that window and that window. And when this happens, that happens. This happened, that, and I just watch it. And then, okay, on the next downturn, and that thing go down, boom, I get in. Sure enough, it's coming back up, and then I cash out, right? And so there are more detailed ways of doing this, and one of the ways is through what we call technical analysis. Right? This is being able to really kind of tune in and track stock movement and notice patterns and all that kind of thing. Now, I don't do technical analysis. I haven't learned that. I'm actually leaving tomorrow morning at 3:30, heading to Georgia. I'll be back Saturday for a 2-day workshop teaching me how to do technical analysis. And I'm bringing everything back and I'm teaching y'all everything I know. Right? Now, what I do is what we call fundamental analysis. right? So the fundamental analysis is a way to kind of check the vitals of a company to see if the company is healthy or if it's not so healthy. And then I'll teach you guys that too. I was going to go into some of that tonight, and then I thought, maybe we'll start next week. Yeah. Uh-huh. Yep. Mm-hmm. 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 Yep. Yeah. 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 No, man, you own it. You you own it. Yeah. In fact, I was just talking. I was telling Benita. I was like, Benita, Meta, right? Just Meta, right? So because Meta fell, what was it like $100? Yeah. Yep. Yep. Right. And the question is, why did it drop? So sometimes the market can be a diva. Serious. Like it just swoons for no reason. They be doing too much. It's too emotional. And so Meta had a earnings call, right? The earnings call is when companies have to report how they did for the quarter. So they did an earnings call, and there was some kind of tax bill that came in that they had to pay, like some super large tax bill. It was a one-time thing, and it threw their numbers off in terms of reporting for the quarter. And so, and then right after that, boom, everybody, and people, and even the analysts, they were like, what just happened? Like, what's the problem? Nobody could figure out what the problem was as to why people sold off so much. And so one guy said, he was like, man, they just overreacting, right? and so like now, I opened up a position for, I have a options contract for Meta, right? That I opened in the low sixes. I wish I would have got it at the 582, but I did the low sixes. I told Benita, I said, Benita, if it get down, because she was like, is it a good time to buy? Is it a good time to buy? And I was like, hold on. Let's see if we can get it down to about 6. If we get it down to about 6, we right there. Because what I did was, okay, see, now I'm getting too technical. I know. I know I'm getting too technical. But I told Benita, I said, this would be a good time to buy right here. Right? And so her and I, we were both eyeing it, looking at it, right? And so I went and got an options contract. And she said she got some, but here's what everybody feels. Everybody feels the next stop for Meta when it goes back up, it's not going to stop till it get to 800. And then they feel that when it gets to about 800, it'll meet what we call resistance. It'll go back down a little bit, and then the next thing is it's going to 1,000. Everybody I talk to, everybody I'm listening to feels Meta is going to be $1,000 stock in the next 2 years. Right? No guarantees, but that's the general consensus. And it's a general consensus because of the strength of the company and the acuity of the CEO. Mark Zuckerberg is a heck of a CEO, right? And so again, yes. Thank you, Chris. I appreciate that. All right, here we go. So now I want to switch a little bit and kind of go back and pick up from here. There are three main ways to build wealth with stocks, okay? Three main ways to build wealth with stocks. Now, before we get into this, I want you to write something down, and I want you to circle it or highlight it because I never want you to forget this, okay? I want you to write this down, circle it or highlight it. I never want you to forget it, okay? As you're learning, don't focus on dollar amount. Don't focus on dollar amount. Dollar amount will discourage you. Don't focus on dollar amount. Focus on percentage. Okay? You want to focus on percentage. Let me tell you why. If I give you $1 and I give you another $1, how many dollars do you have? Is that a lot of money? It's more than $1 that I used to have, but that don't really get us up in the morning for $2. But if you stop focusing on the dollar and you focus on the percentage, you just got a 100% return. So now if I give, if you got 100,000 and I give you 100,000, is that worth getting out of bed? Absolutely. Right? Because, yes, you stay up all night, right? And so, right? So if I tell you in the morning, I'm going to give you another $1 for the $1 you got, you're finna go right to sleep. But if I tell you in the morning, I'm going to give you 500,000 for the 500,000 you got, you ain't going to be able to sleep. You're going to be trying to talk, hey, is he really going to give me this 500,000? And so this is why I want you to focus on percentage and not dollar amount, okay? This is important, yes. Oh, it did? Oh, I'm teaching. I can't turn it. You can do it. You can, feel free. All right, so, okay, here we go. All right, here we go. Okay, here we go. So there's three main ways to build wealth within the stock market. Everybody ready? Here we go. Way number one. Boom. Share price appreciation. Okay? Share price appreciation. What does that mean? That means that the price of the share of the stock that you purchase goes up, right? That's all that it means, okay? Now, watch this. Why does it go up? It's due to the increase of the company's profits and interest from shareholders. The price of the stock goes up over time, okay? So share price appreciation. You purchase something for $20, it goes up to $30. That is share price appreciation. Does that make sense? Okay? And so it's due to the increase of the company's profits and interest from shareholders that the price of the stock goes up over time. What that means is more people are interested and more people start buying. Now, here we go. B, this strategy of investing is called buy and hold. Okay? Buy and hold. This is a particular strategy of how to invest. This is called buy and hold. What is it called? All right, now, here we go. The attitude is passive. Okay? This is a passive way to invest. And I don't mean passive in a negative way. What I mean is you're just not giving it as much attention, right? And so it's a passive way to invest. You buy it and then you hold it, okay? You watch it occasionally, but you buy it and you hold it, all right? Now, the minimal time for a buy and hold is 5 to 10 years, okay? 5 to 10 years. My recommendation, don't consider buying a company that you don't think you're going to be in. If you can't see 10 years of life in this company, it's not a company you should buy. You got to be able to see 5 to 10 years of life in that company. Does that make sense? All right? So you got to be able to see 5 to 10 years of life in that company. If you can see that inside of the company, it may be a good company to buy and hold, given other factors line up as well. Okay? Now, here we go. The strategy is to do what we call bulk purchasing or dollar cost averaging. Is everybody with me? Bulk purchasing or dollar cost averaging. So what is bulk purchasing? Bulk purchasing is you save your money, and then when the stock pulls back, right, it's on a nice pullback, right? Not a sell-off. It's on a nice pullback. And when it gets to a reasonable price, you take the money that you've saved up and you dump just about all of that money or all of it into that stock, and you purchase as much as you can with what you have. Okay? You purchase as much as you can with what you have. Okay? That's bulk purchasing. You buy as much as you can with what you have. So my son just opened up his account, and he was, finally got his account open. What do I buy? And so I said, I want you to buy some NVIDIA. And so he was like, okay, how many shares? I said, how much you got? Right? How much you got? How much you put in there? Right? Or I put this much. Okay, buy as many shares as you can right there. Right? And then I told him, and if you find that it pulls back another 5%, buy as much as you can with what you have, right? And another 5% as much as you can with what you have, right? These are bulk purchases, okay? And so this is bulk purchases are really, really, really helpful down the road, and I'll tell you why. I own 100 shares of Apple. What's Apple stock going for right now? What's it going for? 277. I bought it at 121. I wish I would have bought more Apple stock at 121. Right? Because with all the pullbacks, it ain't never went back to 121. Right? And so bulk purchases allow you to benefit down the road, because if the company is a good company, and if the company continues to go and the stock price goes up and up and up and up, you'll get to a point where even at major pullbacks, unless something is terribly wrong with the company, in which you probably need to sell your shares at that point, but even like you don't have pullbacks that will bring you back to that original price.
I have a question. I know somebody that has a lot of Apple stock, and they keep saying they're waiting for it to split. What does that mean?
To split? Trying to think how I can explain split without taking like 30 minutes. So a stock split is, and I don't think Apple gonna split. But a stock split is when the price of a stock, what happens normally is the stock gets to a price that becomes it's felt that the stock is too expensive for people to come in and purchase. And the company is also looking to raise money for different things that they want to do. So what they'll do is they'll do what's called splitting the stock. So they will take, and then the board of directors has to approve it. And once they approve it, they'll determine what the split will be. So, like it could be a 2-for-1 split, it could be a 3-for-1 split, a 4-for-1 split. When Chipotle split, it was a 50-to-1 split. When NVIDIA split, it was a 10-to-1 split. And so what that means is for every one share you have, if it's a 10-to-1 split, you will get 9 other shares for the one share you have. Okay? Now, each one of those shares will still add up to the same amount, right? So let's say the stock price is $500 and they do a split and it's 5-to-1. You will now have 5 shares that's $100 each, okay? Because you had one share that was 500, 5-to-1. Now you have 5 shares, each for $100. Now, like, that's one of the ways people get really, really rich when stocks split. Yes. Yes. Right? Because if it gets back to $500, you no longer have one stock at 500. Now you have 5 at 500, right? And so people have historically done really well and made a lot of money on stock splits. The only problem is you don't know when a stock will split. Like Netflix just split. Was it 10-to-1? And so they were like 105 or something like that. But now something happened, right? And since something happened, I think they're down now to like 92, something like that. Yeah. So yeah, I have so many shares of Meta that I purchased when Meta was a lot cheaper. I'm hoping they get to 1,000 and split, right? And then get back to the 1,000. Listen, they split and get back to the 1,000. Listen, we PFBC, we chilling at that point. And so yeah, so for me, one of the things I like to do, this is one of my cheat sheets. You don't have to do this, just me. I make a list of companies that are growing substantially and they have good fundamentals, meaning the company is a good company, it's a healthy company. The future projection of what this company is and is going to be and what it's doing, it's emerging. They're making deals, partnerships, things are happening. I mean, the company is growing and moving. I'm very, very interested in companies like that that are over $500. And the reason why is because normally between the $500 and right around the $1,000, maybe $1,200, a lot of companies like to split for whatever reason. And so if I can get in at the low, right? If I can get in at the low on a company that never split. So I bought Goldman Sachs. Right? I bought Goldman Sachs when it was like $500 and something. Goldman Sachs today is like 8 something. Right? And so everybody today was like, man, they're going to be 9 by the end of the year because they like upper 8s. They like 880, 885, something like that. Right? And so, but they've never split. And they are moving. And so ride these shares on up. I may get a few more in between on the ride up, and then if they split, won't he do it? Won't he do it, right? And so that's just one of my things. I make a list of companies that typically they're over $500, and they're doing really, really well, and they've never split. Why do I do that? Because I'm looking to be able to get in on the low, and then if it splits at a higher price, then I can I can double my shares, and then if the company is still growing, a good company is going to do what it does, right? And so like Goldman Sachs has years of life left in it. Years. Same thing with, a bunch of other companies like that. And so that's just one of my strategies. Okay? Any other questions about that? Did I explain stock splits? Okay. Okay, all right, here we go. So the strategy is either bulk purchases or dollar cost averaging. So what is dollar cost averaging? Dollar cost averaging is investing a fixed amount of money every month or at regular intervals, and you're not really tripping off of what the stock price is, right? So it's investing a certain amount of money at different intervals or at different times. Normally, when people dollar cost average, they normally do it on a monthly basis, because what they've done is they've gone through their budgets and they've slotted they're going to invest this much per month, right? Whether it's $50 or $100, $25, $200, $1,000, whatever it is, right? Whatever your budget is. People will take a certain amount and say, okay, I'm going to invest this every month. And what they do is they'll go in and they'll buy shares of the same stock. That's called dollar cost averaging. So that sometimes when you buy the stock, the price is going to be up, right? That's the idea. Sometimes when you buy the stock, the price is going to be up. And sometimes when you buy the stock, the price is going to be down. And so you'll have some of the stock that you purchase where the price will be up, and some where the price will be down, and the average in between there will be what you actually paid for the shares. Does that make sense? Okay? So they call that dollar cost averaging. One of the advantages of dollar cost averaging that people do, and the reason why people do it, is because it gets them into discipline and consistency of investing. Okay? One of the easy things to do when you're investing, one of the easy things to do is to forget, right? And then you just don't do it. And you haven't done it in a long time, and then you'll have an account that you had for 3 years, and you forgot you had it, And then you'll come back, and sometimes you'll come back and all your money gone, and sometimes you'll come back and all your money up, right? And so it just depends on what you picked when you forgot you had it, all right? And so people will do dollar cost averaging because it gets them into regular intervals of actually putting money in the market. Does that make sense? Okay, all right, here we go. Let's see. Boom, boom, boom. Where are we at? Okay, the goal is to buy low, sell high. That's the goal, right? With buy and hold. You buy low, you sell high. That's the goal, okay? Now, here we go. Next. The second way is what we call a dividend payout. Anybody familiar with dividends? Okay. All right. So a dividend payout. So what's a dividend? Okay. Company pay you money. Okay. All right. So a dividend is a portion of the company's profits that they decide to share with the shareholder. Kind of like profit sharing on your job, okay? And so this is what we call a dividend. Now, a dividend, here it is a portion of the company's profit that the board of directors has decided to share with the stockholders. Now, this strategy of investing is called dividend investing. There are some people who only buy dividend companies, right? There are some people who their whole strategy is to buy companies that are dividend companies, because they not only want the ownership of the company and for the share price to go up, they also want to get paid on top of it, right? And so you can have both. You can have the appreciation of the company, and you can also get paid on a regular basis if the company gives a dividend. Now, what you have to keep in your mind is all companies don't give dividends, okay? Some companies do, but not all companies do, all right? Now, the attitude when you dividend invest is passive. This is another passive investment. Okay? Minimal time, I would say 10 years plus. Okay? 10 years plus. You want to lock in. Right? And if a company is paying you on a regular basis, why you want to sell it anyway? Right? Lock in. Okay? 10 years plus. Now, the strategy is bulk purchases or DCA, dollar cost averaging, same thing, right? And then you always want to purchase with the dividend threshold in view. Let me explain that. You always want to purchase with the dividend threshold in view. Is everybody ready? See, y'all got to talk to me. Okay, so you always want to purchase with the dividend threshold in view. What does that mean? The dividend threshold is this. How many shares of the stock do I need to purchase in order for the dividend they pay me to purchase another share of the stock for me? Is everybody with me?
Whatever money you make, you just go put it back in and buy some more, whatever you make.
You got it. This is called turn on the drip. Okay? Whenever you purchase a share of stock in your account, there is what's called the DRIP, the Dividend Reinvestment Program. What that does is whenever you cut your DRIP on, if the company you purchase pays a dividend, it will take the dividend and instead of putting it into your account as a cash deposit, it will take that, it will take that money and it will turn it into shares. Right? And it'll turn it into fractional shares or it will purchase whole shares depending upon how much dividend you have coming in. Does that make sense? All right? So watch this. Here's one of my strategies. Right? So I'm giving you my strategy. ExxonMobil. You guys know ExxonMobil? All right? So ExxonMobil has a 3.45 annual dividend yield. That's actually pretty good, right? Which means they pay $1.03 per share per quarter. You missed it? Give it to you again. ExxonMobil pays $1.03 per share per quarter. Their stock price today was $1.19. Now, watch this. So I ran this scenario 2 weeks ago or a week ago when I wanted to do this. I didn't do it, so my numbers are going to be old, okay? So last week, listen carefully, their share price was $1.15. So here's a scenario I asked chat to run up for me, okay? So this is the constant dividend, constant price scenario. So if the dividend stays at $4.12 per year, $1.03 per quarter equals $4.12 per year. You got it? Okay, so if the dividend stays right there at $4.12 per share and the price stays at $1.15, right? So after 10 years, if this stays, nothing changes. Everything stays the same. What this will do is it will take this $4.12. Oh, I gave it another scenario. I told it that I bought 100 shares. Okay? So if I buy 100 shares, this is going to give me $412 a year. You got me? What it's going to do is every year it's going to purchase more shares for me with the 412. Just because I own the stock. I'm not doing anything else. I'm not adding any more money. I just own it. And because I own it, it's giving me more shares because I own it. So at the end of 10 years, if I did that and didn't do anything, didn't add anything, I'll end up with 141.80 shares. Does that make sense? All right, so here's another scenario. If the dividend grows by 3% per year, but the price stays constant, the dividend starts at $4.12, increases 3% per year, price stays at $1.15, results after 10 years, it will purchase for me, I will have 149.8 shares. Okay? Now, I can see that's not exciting to you. But do you know this guy? You know this guy? Chris, who is this guy? Yeah. This is the Chase CEO. Okay? Now, here's what you got to know. He owns 6.5 million shares of Chase. Let's see if it looks interesting now. So I'm going to give you a big dividend case just because I need you to see what this looks like. That's why I'm saying don't trip off the dollar amount. Focus on the percentage, right? Watch this. There's JP Morgan. They got a 1.93% dividend yield, which means they pay $1.50 a quarter per share per year. Their stock price is $3.10. He owns 6.5 million. Current dividend per share, $6 a year. Total dividends you'd receive in cash without the drip, $39 million in yearly dividends. At $300 a share, I just took it down from 310 to 300 so that it'll be even. So if he cut his drip on and he's getting $39 million a year in dividends and he has the drip on, every year he's getting an extra 130,000 shares of Chase at $310 or $300 a share. Exciting now? Now, here's why I say you want to keep this for 10 years plus. Because typically, the dividend price goes up as the company does well, so that your dividend value goes up. And you want to go deeper into shares. You want to own more shares. Because, see, here's the thing. This is what you call compounding. Next year, right? When this calculates, it's not calculating he's not calculating 6.5 million shares. Now it's calculating at, No, it's not calculating at 6.5 million shares because now he has 130,000 added to the 6.5. Right? And because he has 130,000 added to the 6.5, now it's 6.6. Right? So now the calculations are happening at an advanced pace every year. See, here's what most of us don't understand. All of these big CEOs, all of these big guys who have all of this money, these millionaires, billionaires, all these people, they don't have that money cash. They do not. They have it in stock. They prefer it in stock. And the reason why they prefer it in stock is because they can take advantage of stuff like this. Am I making sense? Yeah, right? And so not only, because when you do dividend investing, not only do you get the appreciation of the price of the stock, right? You get stock appreciation, but you also get free shares that the dividend buys for you, like every year. So when I'm looking at XOM, right, and XOM is, this is where I can play. XOM is at $119 a share, right? So if I go get 100 shares, that's going to cost me right around $11,000 or so, right? Or, my buy-in is 110. I'm trying to get it back to 110. But it'll cost me about, $11,000 or something like that, right? Over the next 10 years, I believe I can add probably another 200 shares to that just over time, right? Just purchase per dollar cost average. Just purchase, add, purchase, add, purchase, add, purchase, add, purchase, add. So the scenario that I painted for you, that's a scenario if you set it and forget it. But because we're investors, we don't just set it and forget it. We invest, we do this, we do that, and so I'm going to get the stock appreciation as well as the dividend payment that purchases more stock for me. Does that make sense? Watch this. How many of you would be excited if somebody just handed you 49, 50 shares of XOM right now? Just handed it to you for the free ski, right? Just for owning it, right? That's what we're talking about. Right? And the more shares you get, the bigger the dividend payment pays. Now, there are some companies who pay bigger dividends than others. There are some companies, they'll pay you $3 or $4 a quarter. Right? And so if you're going to do dividend investing, you got to be careful about what you want. You want to do your due diligence and to find out and to know what companies pay dividends, what companies are good. Somebody sent me something maybe a couple of weeks ago, and they were like, ooh, check this out. This company pays a wicked dividend, blah, 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 blah. But then when I looked at the company and did the fundamentals on the company, the fundamentals were trash. And so when I looked at it, I was like, I'm not going to be able to invest in that, right? Why? Because I'll get the dividend, but I want the dividend to buy me more shares. But I don't want to buy more shares of trash. Does that make sense? Right? So hopefully all that makes sense. Okay? All right, so let's see. I explained this guy, right? Yeah. All right. So let's see. We went through this. All right, I got 6 minutes. Okay, here we go. Okay, here we go. This is the last part. Stock awareness. Okay? I want you guys to position a few things in your mind about being aware of certain stocks, okay? So there are some stocks that I need you to kind of this is your list of things that you need to be aware of. These are not companies. These are things that you want to be aware of. Here we go. Number one, there are 6 types of stock that you need to be aware of. Ideally, you want some of these to be a part of your portfolio, your collection of stocks. Okay? And so here they are. Number one, you need some growth stocks. Okay? Growth stocks will probably, right now, growth stocks are probably the technology stocks that we talked about last week. Technology for the last 26 years has fueled the stock market. Right? Technology. And so growth stocks, you'll find a lot of your growth stocks in technology. So like NVIDIA or TSM or, Meta or, Microsoft, and then there's some new ones, PLTR, man, blowing the doors off of stuff. And so these are stocks that grow really fast. They're rapid. They increase, they grow, they do their thing. There's some stocks in the financial sector that are possible growth stocks. They haven't taken off like everybody had hoped that they would, but their day is coming. One of the big ones is SoFi. That's one of the big ones everybody got their eye on now, SoFi. And so you want a growth stock, okay? And then you want a dividend stock, some kind of dividend stock, something that just pays you just for owning it, okay? Can't go wrong with a dividend stock, okay? So Coca-Cola, Exxon, Chase, it's a bunch of them. Bunch of different ones. You can even get into REITs. Okay, a REIT is what's called a real estate. Yeah. So a REIT is a real estate investment trust. And so what a REIT is a group of is a company that has a group. It's like a mutual fund or an ETF, but everything in there is all real estate projects, right? Like malls and strip malls, all kind of stuff. It's all these different real estate projects, high rises, all that. And so, Oh yeah, oh there you go. And they pay a month REITs pay a monthly situation. I don't yeah. You can get paid monthly off REITs. In fact, there's a few people I know who started off small in REITs, and they make actually, because they've been in them for so long, like 5, 6, 7 years, they actually make a decent, almost livable wage from REITs, right? And so dividend stock, cyclical stock, okay? A cyclical stock is a stock that has a season every year, right? It keeps going, right? I'm not suggesting any stocks, but just as an example, like Disney is a cyclical stock. Why? Because people keep having babies, right? And everybody wants the Disney experience, so Disney keeps coming up. There's a whole thing surrounding Disney that keeps them in business. Airline stocks, even though I don't recommend them, but airline stocks are cyclical. And there's a bunch of other stocks they have a built-in time frame in which they have revenue and business and all of that. Okay, cyclical stocks, and then blue chips. Okay, blue chips. Blue chips would be your well-established companies, right? These are your dinosaurs. They're not going anywhere, right? They've been here forever, and they ain't going nowhere. And so blue chip stocks are actually stocks that people use for safety, right? They'll run to those for safety. So they'll put money in them for safety. Now, I'll give you a company. One company that is a blue chip stock, but it's turning into a growth stock. IBM. IBM kind of maxed out on what they did, and everybody start passing them up. And man, this AI stuff and moving into what we call quantum computing, listen, I looked at IBM, I was like, what? Y'all up 58% for the year? Y'all up, wait. And before I even knew it, man, they stock taking off, right? They performing like a young tech company right now. And so IBM. Defensive stock, right? And I don't mean like rockets and missiles and stuff. When I say a defensive stock, I'm talking about a stock that people need, right? These are companies people need. Like people need their insulin, right? People need certain things, and so you want to invest. You want to have some companies that are meeting needs that people have. Why? Because there's always a market for it, no matter what the stock market does. Pharmaceuticals is one. Mm-hmm. Yep, could be. Procter and Gamble. Not car companies. I don't like car companies for some reason. I've just never been a fan of car companies. Yeah, but defensive, meaning people are going to buy this if the market is up or if it's down. Right? That's a defensive stock because it protects you from the volatility in the market. Does that make sense? All right. And so defensive stock. And then lastly, speculative, right? I think, and people may disagree with me, but this is my opinion. I think that everybody ought to have a little bit of speculation in their portfolio. What is speculation or what is a speculative stock? I don't know if this is going to work or not. You know what I mean? This is a small company. They look, I ain't saying go out there and, you know what I mean, somebody, we gonna make a self-driving chair, right? You know what I mean? You can be on the freeway with your chair. No, right? But something that is decent, that like, for instance, let me give you two companies. One company is called Joby, Joby, Joby. Another company, which is their competitor, is called Archer. Okay? What do? They are at the forefront of, and actually at the head of, at the head of the line, building personal transportation vehicles. No, not Waymo. No, 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 no. They'll it can be custom made for you. So this is Joby. You go outside in your backyard and you get in your personal helicopter. Hit the button, and that thing and fly you everywhere you want to go. It's like a helicopter taxi or whatever it is, a personal little, like a hover kind of thing situation. Yeah, listen. Listen, all that stuff we used to watch, the Jetsons and all of that, we here. We here. And what I'm telling you is, like companies like that, Joby, Archer, a few others, they're at the head of the line. They're actually doing the thing and have government approvals and going through the testings and getting licensed and man. Yeah, like that's, you know what I mean? I had a friend of mine made a gang of money off Joby because I think he purchased he told me he purchased like 10,000 shares of it, but it was like when it was like $2. Joby at like $18 right now. Listen, he over there looking nice. You know what I mean? So, but like when you start looking at like PLTR, right? Palantir. Palantir is a company that when it came and hit the market, people who saw it got in it when it was like $6, right? About like $6. Look up Palantir on your phone. Just look up Palantir. How much is Palantir stock? Just look it up. PLTR. PLTR. 187. And when I'm saying it was like at $6, I'm not talking about 15 years ago. It was like 2 years ago. Right? So what if you could have gotten Palantir at $6? Palantir, let's say it goes up to 500, 700, or whatever, and then it splits. Listen, you're a short-time millionaire, right? Depending on how many shares you purchase. And so when you like for me, I looked at SoFi. I love SoFi for what they offer, for what they do. I love their agreements. I love where they're moving. I love everything about SoFi. So I went and bought a quick 100 shares because it was only it was less than $3,000. So I bought a quick 100 shares, and then they just went down. Something happened. They I forget the thing that happened, but the investors didn't like something they did. And then it went over the last few days. It went down another $2 or $3. So I'm like, man, go get me another 100. Yeah, you talking about for SoFi? For SoFi, it was number one, their fundamentals. Their fundamentals are sound and solid. Um, so just so you know, so I'll explain this in much more detail later for everybody. Um, I'm at core. So there's two things about me. Number one, at core, I'm a fundamental investor. I do not invest in companies that I don't feel can cut the mustard fundamentally. You got to have for me to put my money. You got to have sound books. You got to, and I'll teach you guys all that stuff. But that stuff it has to be sound. You know what I mean? It's like, so that's one. And then number two, I am a buy and hold investor, but I do other things to fuel my buy and hold, right? And so one of the things I'm going to teach you guys is options. Options is a way to do what's called supercharging your account. Being able to learn how to trade options is a way for you to make a lot of money really fast, relatively fast. And the goal is to take some of that money that you make in options and you turn it into buy and hold, right? So when I'm talking about I want to buy like shares of XOM and I'm saying it's going to cost 11,000, I'm not talking about saving my money, saving up $11,000 and going buying 100 shares of XOM. I'm talking about getting in an options trade and making 11,000 and turning that 11,000 into 100 shares. Does that make sense? What I'm saying? So I'll explain all that to you. Just keep coming. I'll explain all that stuff. But SoFi, man, I like the agreements that they have with and the people that they're partnering with and the direction that they're looking to go. Not only that, like their cost of acquisition in terms of customer acquisition is really, really low, and it's quite impressive. They seem to be one of the few companies in the fintech space that has been able to really to kind of penetrate sort of this new kind of this new group of people coming up who still have to do banking. It's the same people, and maybe this will make sense. They're the same people that do everything on Robinhood. I like the clientele. Yeah. Huh?
So you like them for personal reasons?
I like them for no, not personal reasons. I like their business, and I like the fact that they're not just fintech banking. They have SoFi Invest. So you can invest with SoFi. They're moving into the crypto space. They're like, oh man, like everywhere finances touch, SoFi is moving into those places from an electronic standpoint, which is exactly where the momentum of the world is moving. And a lot of the younger people coming up who have to do banking and everything else, man, everything fits right into all that they do and offer. And it's not cheap stuff, right? Like their stuff is quality. And so, yeah. And they have SoFi, and I love this. SoFi gets a lot of people to sign up with them because the last I checked, they offer, they have the best, either the best or one of the best high yield savings accounts. I think they pay you like like the high threes for the savings account, and then and for a lot of their stuff, they'll pay you like $500 to sign up. Like yeah, check out SoFi. So yeah, I think yeah, I think they might be undervalued right now. Yeah. Mm-hmm. Oh, gee, yeah. Mm-hmm. Ah, see, that conspiracy. They don't want you to know. They don't want you to know. They're like, cut off. So, all good. You can ask me anytime. You can ask me anytime. Okay? All right. So, was this helpful at all, guys? Yeah? You learned a couple things? Yeah? All right. Couple? Good. Good, good. All right. Thank you for coming out. God bless you. Good night.
And you know, while we talking, we writing, that's why sometimes we can't, we can't do a bunch of talking.
I got you.
Trying to listen.
I got you. I got you. I got you. I didn't.